Does the calculus change at all given these impeachment inquiry risks?
No, I think the impeachment inquiry risk is just that it's noise and it's short-term risk. Remember, political events don't really price stocks in the long term. They do, though, create opportunity in the short term because of the nervousness and angst that the headlines, whether, from moment to moment, day to day, the headlines will create that angst. And you saw it yesterday, the minute the algos get a hold of those headlines, they're negative, the market sells off. And then he comes out and changes the narrative completely and talks about how close China is to creating a deal, and the market does a complete turnaround. And so I think the long-term investor and retail investors have to understand that you got to eliminate that noise, and although the risk is out there with the impeachment, in the end it doesn't go anywhere. The House may vote to impeach him, the Senate would never vote because it's GOP control.
I guess what I'm wondering is there a linkage between the trade strategy from the administration and the outcome and what the market is pricing in?
I think there's a link for China. I think there's a big linkage now, right? I mean, you said it when you came in. Maybe they're going to find it better off to play hardball and sit back and watch how this plays out. On the other hand, Trump may be feeling a little bit of pressure to get something done. And so you may see him start to kind of wiggle a little bit. But my sense is he's too defiant. And so I don't think he's going to end up doing that. But I think the strategy really falls into, the ball's in China's court at the moment.
How do you think investors should play it?
Well, so I think the most important thing about trade, after recognizing that it's really the most important issue for the market, is for the markets to go higher, we don't need to resolve all the issues related to trade. All we need is for things to not get meaningfully worse. So if we stick with tariffs, and we are really just talking about tariffs, the slowdown in the economy and the markets to some extent have built in that expectation. So it's really about these negotiations will go on for a long period of time. Looking for a resolution is probably waiting for Godot. However, I think markets can go higher because economic data is stabilizing and the financial easing is kicking in. We are seeing that in the housing data in spades.
Do you believe that the pressure that comes with the inquiry on the White House makes it less likely to, or marginally less likely to go forward with tariffs? More tariffs?
Well, so I think from Trump's re-election perspective, the one thing that he needs to see is for the economy to work. And I think it's really that far more than impeachment, because impeachment is not going to get through Senate anyway. So it's really a political show. What matters is economy has to come back, and we have slowed down to a level. I think he has an incentive.
So he gets more dovish on trade?
Yeah, he has to be dovish on trade because he's a rational actor.
Do you agree, Kay?
Right. Well, that's what I just said, right? If this continues to go on, he's going to have to be put in a position to try to figure out, all right, how am I going to keep this going? And should I become a little bit more cooperative and compliant to try to get something on the table? Because every time we see a headline about trade, you see how the market reacts, right? So I don't think it's completely built in yet. I think the market is yearning for something, even if they're small pieces, to keep it going along until we get to a point where the economy continues to not slow down anymore.
I think the data in the back half is going to strengthen enough to support the market.
Right.
The trade issue can take things away from that. And if we don't have a resolution, or if we continue to go down this path of exacerbation, we'll have a problem. Otherwise, we are set up the right way.
The data's been relatively good, actually, and it's the U.S. consumer, and it's now housing, and it's even inflation firming. Yesterday on Closing Bell, we talked to the CEO of Mondelez. They own Oreos and Nabisco. Listen to what he says about the U.S. consumer right now.
We see basically a consumer that feels pretty good. I mean, as you said, snacking is not necessarily going in line with all the economic twists and turns that you would see. But overall, the snacking market, particularly the biscuit market in the U.S., is growing more than it has been in the last 2 or 3 years. So we do not see any signs that the consumer is sort of affected by all the news that is going around.
So what does that ultimately mean for the markets if the consumer stays strong?
I've been saying it for a while. I think our economy is strong. I think the consumer is strong. And by the way, Oreos are great. Let's just say that at the very beginning. They're great.
Finally, something the country can all agree on.
But so I don't see this problem, which I keep asking why, especially now Bullard, right? He's so dovish on wanting to cut rates. I think it's pushing up the string.
So let's hold on there for a second. So the consumer part of the economy is doing fabulously well. There's no doubt about that. Consumer income, unemployment, everything looks good. But the manufacturing side of the economy is not doing very well. Capital expenditures have dropped off because of trade issues. So I think that is really the driver at the margin. It's not the consumer economy. Consumer economy is strong. For the manufacturing to go up, we need some resolution on the trade front.
Why do we keep hearing about even non-manufacturing margin compression because of higher wages? Right?
Well,
is that not a worry?
No, so that is certainly a worry. But I think you have seen in the data enough productivity growth to kind of make up for that. So margin compression is happening primarily because the underlying growth trends have deteriorated meaningfully from last year. That with the easing of financial conditions, that is going to improve back half of this year, if not this year, in 2020 for sure.
So bottom line, Kenny, what it means for where you should be invested. Seeing a bid for bonds again today, that means utilities, staples, and real estate are leading the market. Is that the place to be?
Well, listen, I think it's certainly that those names have to be part of your portfolio, but I'm also a big believer in this shift from these high growth stocks more into the value, especially if you're concerned about the economy slowing down or about the trade war continue to be dragged into 2020, along with the impeachment, all that other noise that's around it. I think there's a real shot at picking up some value names.
What's value to you?
Well, listen. I like energy. I don't think people. I don't
deep
think
value.
I like deep value. I think there's a huge opportunity in energy. I know we've seen oil come back down after that spike yesterday. All that means is I don't think it's a global slowdown. I think there's an oversupply in oil. That being said, though, I think there's a huge opportunity in energy going forward.